Welcome back, focused learners. Okay, today's explainer is absolutely critical because we are looking at a profound geopolitical shift that is literally sending shockwaves across the globe right now. And more importantly, it's sending those shockwaves right into the heart of the financial markets. We're seeing major international developments triggering a massive market gap up, and beneath this wave of, macro euphoria, some of the biggest corporate giants out there are experiencing intense, game-changing catalysts. If you want to understand exactly how these global tremors translate into your local stock movements, you are absolutely in the right place. Let's get started.
It's the ultimate question, isn't it? Like, how does a breaking peace agreement brokered thousands of miles away between the US and Iran actually filter down to affect your money? Well, when a choke point like the Strait of Hormuz suddenly reopens to the world, those ripples don't just stop at the shoreline. They crash directly into your equity portfolio. Today, we are going to trace that exact path, step by step, from the global geopolitical stage right down to individual company stocks. Okay, let's dive into this. Here is our ripple effects journey for today. We'll start with global shifts in macro outlook, move into nifty technicals and currency forecasts, look at bullish catalysts and value unlocking, check out regulatory headwinds and block deals, and wrap it all up with a strategic market outlook.
Starting with Part 1, Global Shifts and the Macro Outlook. So, under a draft U.S. memorandum, a historic peace agreement with Iran has just been announced. The market mechanics here are pretty straightforward, but they are incredibly powerful. Basically, Iran has agreed to immediately reopen the strategic Strait of Hormuz to all commercial vessels. And in tandem with that, Washington is lifting its naval blockade. The result? An immediate, massive global relief rally. For our domestic markets, this sudden easing of geopolitical tension is acting as a major catalyst, triggering a very clear gift-nifty gap-up opening. It's honestly a textbook example of how quickly global capital flows react to open trade lanes.
However, we do need to balance our perspective here, right? The macro environment isn't entirely frictionless. We're impartially tracking two persistent headwinds that are still in play. First up, the U.S. administration continues to enforce its Section 122 global tariffs at a 10% rate. That maintains a solid layer of friction in global trade, despite some ongoing legal challenges. Second, there is still unresolved regional tensions. Specifically, we're looking at recent maritime attacks on commercial vessels carrying Indian crews off the Oman coast. The Indian government has formally protested these incidents to a senior U.S. diplomat. So these are the underlying currents of volatility that are definitely still running beneath the surface of this relief rally.
Let's move down the funnel to Section 2, Nifty Technicals and Currency Forecasts. And this brilliantly illustrates the exact battlefield for the indices right now. Because of that global gap up we just talked about, the Nifty 50 is caught in a highly specific trading bracket. Over on the left, our critical support zone sits firmly at 23,100. But look at the right side. The key resistance zone is right there at 23,330. The mechanics here are absolutely crucial. If the market can actually sustain the momentum generated by the global relief rally and break above that 23,330 mark, it clears the runway for the bulls to easily push the index toward 23,500 and beyond.
So what is giving those technicals the confidence to push higher? Well, it's the fundamental momentum you see right here on this chart. The World Bank just released their projections, and guys, they are incredibly robust. They've retained India's FY27 GDP growth forecast at a really solid 6.6%, but more importantly, they actually raised the FY28 outlook to an impressive 7.2%. So while the technical charts are kind of bouncing around reacting to the daily global news cycle, the structural long-term foundation beneath those charts is steadily expanding.
Now let that number on your screen sink in for a second. $65 billion. This brings us to a really groundbreaking report from SBI Research. Driven by recent RBI reforms, SBI is forecasting unprecedented US dollar inflows into the country. We're talking about a range from $55 billion to the absolute top end of $65 billion. The sheer gravity of this expected capital inflow is projected to firmly stabilize the Indian rupee at 92 per US dollar. And listen, that kind of currency stability, that is a glaring, massive green light for foreign institutional investors.
Heading further down the ripple effect into Section 3, Bullish Catalysts and Value Unlocking.
First up is a monumental event for metal and energy investors, which is the Vedanta restructuring. As the timeline shows here, Monday, June 15th marks the official listing date for 4 core demerged entities: Vedanta Oil and Gas, Power, Aluminum Metal, and Iron and Steel. Now, for the first 10 days, these will be placed in the trade-for-trade segment.
That basically means shares must be physically delivered, so no speculative day trading allowed, just to ensure smooth, controlled price discovery. This is a massive one-to-one corporate action designed for one specific reason: to completely eliminate the conglomerate discount and unlock the pure operational value of these independent powerhouses.
Now, what's really interesting about this slide is observing how rapidly domestic IT is evolving. Happiest Minds Technologies just launched Real AI Build. As the definition points out, this isn't just some basic tool. It's a proprietary agentic AI development platform. They are aiming to deeply embed artificial intelligence across the entire software development lifecycle. By doing this, Happiest Minds is positioning itself to help major enterprises drastically accelerate how they create software and scale their AI-driven automation. It's a really significant leap forward in generating immediate corporate value.
Pivoting to the other side of the ledger for Section 4, regulatory headwinds and block deals.
On the negative side of the spectrum, consumer goods major Dabur India is facing a severe regulatory roadblock. They've just received a strict U.S. FDA Import Alert 6640 for their Silvassa plant. And to be clear, this wasn't just a minor warning. It follows critical inspection observations directly relating to data integrity and maintenance lapses. For investors, this is a significant short-term negative impact on Dabur's pharmaceutical and export segments. The market simply does not take data integrity issues lightly, right? So this will naturally create some near-term price pressure as the company has to work toward remediation.
Meanwhile, behind the scenes, institutional money is moving fast. Just look at this rapid-fire list of block deals and corporate actions. Adani Connex just acquired 100% of Madhuvanti Build Estate to supercharge its data centers. JK Paper bumped its stake in Borkar Packaging to over 87%. But the really fascinating activity is right there at the bottom. Large promoter exits in Lenskart, including a substantial 1,900 crore rupee stake sale by ADI, were completely and fully absorbed by institutional investors. Having that much supply completely absorbed, that points to incredibly robust underlying demand. Bringing all these threads together in Section 5, the strategic market outlook.
So, the crucial point is how you actually navigate these possibilities. This scenario matrix breaks it down perfectly. In our bull case, the geopolitical easing from the US-Iran deal, combined with rapid AI adoption, easily pushes the Nifty past that 23,500 resistance, while the Vedanta unlock triggers immediate re-ratings. In the base case, the market simply tracks those steady, fundamental World Bank GDP limits we discussed, resulting in a gradual corporate earnings recovery. But in the bear case, if those persistent U.S. tariffs escalate, or if FDA alerts like Dabur's trigger broader data integrity fears in exports, the market upside will be strictly capped. The strategy here? Growth investors should probably look closely at market leaders capitalizing on institutional block deals, while defensive players might want to wait for absolute clarity on regulatory fallouts before building any new position.
Which leaves us with this final thought. You've seen the mechanics of the global gap-up, you understand the fundamental GDP momentum, and you know exactly where the regulatory risks lie today. So, as you review your own portfolio after this explainer, you really have to ask yourself, are you truly positioned to capture the structural domestic growth and the heavy incoming institutional inflows? Or are you unwittingly exposed to the crossfire of global regulatory turbulence and tariff wars? It's a literal tug of war between macro euphoria and micro risk. Just make sure you know exactly which side of the rope you're holding.